Now, Ross Kaminsky on Denver's talk station, 630 KHOW.
Well, good morning. Happy Thursday, everybody. I'm Ross, and for those of you joining us live on the stream, either on YouTube or Facebook Live, welcome and good morning to you. I hope you'll head over to YouTube and just type in Ross Kaminsky and click subscribe so you can keep in touch with me, whether we're doing live streams during the show or any other time. So, good morning, everyone. I wanted to start today, first of all, by saying I got my Kaminsky chair back, and I'm very, very happy. I went over to Everything for Offices yesterday because while I was on vacation, somebody messed up my chair, and it bummed me out, and I came back, and I was sitting in some not-so-nice chair. So I went over to Everything for Offices yesterday, and on the chairs that they've got out, the chair that's of this, they've got a tag on it that says The Kaminsky. It's really quite funny. Anyway, so I'm very happy. I'm in a much better mood now because I'm in a better chair. I want to start with a story that I don't think you're going to hear anywhere else, at least anywhere else outside of a financial network. This was really crazy. Last night, or evening, our time, there was this flash crash. Now, you've heard about it in stocks, and you've seen it one or two times in the United States in stocks where, for some reason, sometimes they figure it out later and sometimes they really don't. There is this massive, very, very fast sell-off in stock prices. Well, what happened yesterday, and actually we'll talk about it more in the Ross Report and some other stuff, but perhaps triggered by Apple's bad news, there was a flash crash in some currencies. It was really crazy, and this is way out there in left field in financial markets, but it appears that there was this massive wave of short covering in the Japanese yen against the Australian dollar and maybe the Thai lira as well, although that doesn't trade as much. But this stuff was going absolutely crazy. In fact, I want to see actually where the Australian dollar is right now because I watch that one a lot. But so typically currencies don't often move a lot over the course of one day. Currencies are a market where you've got a lot of very huge players, ginormous corporations buying and selling because, let's say Apple sells an enormous amount of iPhones in Japan, so they collect yen. Well, they sell the yen and buy dollars to bring it home. And so you got all the big companies, and you've got central banks, you got governments, you got everybody messing around in currencies. So they tend, especially for the larger countries, to be pretty stable. A 1% move in a currency in a day is something you don't see very often. So I was looking at this chart of the Australian dollar yesterday. So it's chugging along right around being worth, let's call it 70 cents U.S. Okay, 70 cents U.S. And then I just want to check the timing on this here. At 3:15 our time, it's just under 70 cents U.S. At 3:30 our time, it trades down to like in the 67s. It dropped something like, 4% in 2 minutes. So now you're talking about, think about this, the value of all the Australian dollars out there, at least compared to the United States of America, dropped around 4% in 2 minutes. And other currencies had this huge move too, and it's recovered most of it actually. It came almost all the way back up. So just before the crash, it was, let's call it, 0.699, and now it's around 0.697. So it did this basically like a V. But I can only imagine just how much money was made or lost in that time frame. One other thing I want to mention, though, which I think is interesting, and that most people, even to the extent that they play in financial markets, don't play in this aspect that I'm going to describe to you right now, because it's something that is it requires so much money that it's generally really done by banks and large institutions and stuff like that. So we actually had And I've been wondering, question from a listener, or else maybe it was just a question that came up during the course of the show about zero or negative interest rates in Japan. You remember that question? And the Japanese government actually has a negative interest rate because they are trying to do everything they can to get people to borrow money. So basically, they will pay you to borrow money from them, which is pretty nuts because they're trying to stimulate economic growth in Japan, which has been bad for 20 years or more. Okay, so you've got interest rates. Because I think the concept of a negative interest rate really confuses people. So let's just call the Japanese interest rate zero, because that's close enough. Let's call the Japanese interest rate zero. And then you look at some other countries like Australia, and I want to actually look up the Australia short-term interest rate. And let's see what we got. Just under 2%, it looks like, right now. So here's the idea. These very large banks will borrow money in Japan at zero interest rate. So they're borrowing money, and it doesn't cost them anything. And then they'll go invest it in Australia and just put it in, just in government notes, in short-term, basically risk-free stuff that's paying 2%. And so they make a free 2%, right? Borrowing at zero, earning 2%. It's free money. Except, here's the key. Here's what you've done. You borrowed Japanese yen, and you went and bought Australian dollars with it, and then used those Australian dollars to buy the notes in Australia that pay you the 2%, or let's say a bank CD, okay? You have to buy that in Australian dollars. You can't buy it in Japanese yen. So where's your risk? Your risk is if the value of the Japanese yen goes up. Because at some point, you're going to have to sell your Australian dollars, including the interest that you got from the bank. That's fine. And then you've got to go buy Japanese yen to pay back the Japanese yen that you borrowed. And so there's just probably hundreds of millions, maybe billions of dollars in this trade right now. It's just absolutely enormous. So many people going for the free money. And the markets generally will pretty much always do whatever will hurt the most people. That's what markets do. Now, especially, I'm talking about short term. If there's, I'm not talking about lots of people own lots of stocks. I'm talking about concentrated trades. And so you've got an enormous number of people short the yen. And let me try to put numbers on it if I can. So let's say you borrow 100. So you borrow 100 yen worth of. You borrow 100 yen. You convert it into however many Australian dollars that is. It doesn't even matter. Okay, but we'll pick a number. Let's call it 70. I don't know what the number is. So you got 70 Australian dollars, and you go and put it in the bank in Australia, and you earn some interest. And let's say you do it for a year, and you earn, let's call it 75 Australian dollars, and you earn 2%, so you earn 1.5 Australian dollars more. Now you got 76.5 Australian dollars, and you think, all right, that's cool. Now I'll go buy my yen back, and I'll have that 1.5 Australian dollars left of free money. But wouldn't you know it, okay, over the course of time, the Japanese yen has drifted up. So now that 76.5 Australian dollars doesn't buy you all 100 yen anymore. It only buys you 99 or 98. And then you got to just go buy the rest of those yen some other way and pay it back. I realize this is very complicated, okay? But the bottom line is what looked like 2% free money turns into a 1% loser, 2% loser, whatever, because the currency values changed. And so what happened, I think, was you had a lot of banks with what they call stop-loss orders in. So they're short yen. They know they need to buy yen. They're willing to take some risk on the currency, but if it really starts moving, they want to cover and get out. Well, what happened yesterday was they were trading in very thin markets. I think it might have been a holiday in some, Japan was still in their New Year's holiday. And the way stop loss orders work is when the underlying thing, whatever it is, a stock, a currency, gets to a particular price and it's moving against your position, you have an order in to automatically get out of your position. I'll give you an example that'd be easy to understand. Let's say you buy a share of stock for $100. And you know stocks can go down, but you're not willing to risk more than $4 in this stock. So you put what's called a stop order at 96, a stop sell order at 96. And that means as long as the stock is above 96, your order isn't active. You're not going to sell it. You bought the stock and you're hoping it's going to go up. But if something happens and the stock goes down and it hits 96, then it turns into a live sell order at that time and goes and sells the stock. Now, most stop orders are what's called market orders. And that means that once the order gets triggered, it goes and sells, if it's a sell stop, it goes and sells at whatever price is available in the market at the time. Right? So let's say, stick with my example, you bought stock for 100 and you got a 96 sell stop and it trades 96. But it's a quiet day, so the stock's still trading right around 96, maybe $95.99, and your order goes live and it sells and you get a price that's only 1 cent worse than your stop limit, right? 96 and it sells $95.95. Because it's a busy, it's a liquid market and it's not an insane day and all that kind of thing. But what happened yesterday is it looks like all these institutions had stops in around the same price that got triggered on a holiday, on very light post-holiday trading. And so imagine, going back to my stock example, that stock had been drifting down and you're okay, you're waiting on it. You're not panicking, right? It's 99, it's 98, it's 97. It's not good. You're losing money, but you're not panicking. But it gets near your stop price, and so your stop is sitting there at 96. Now imagine this happens on in a really crowded trade where there's lots of stops at 96 and on a really thin trading day. And so there aren't a lot of bids sitting there in the market. So somebody else's stop gets triggered at 96 and it turns out the next bid is 95.5 and that gets hit. And then the next bid after that is 95 and someone else's stop hits that. And before they get to yours, your stop goes at 93, a loss that you didn't even think was possible. And you're just dead. There's nothing you can do about it at that point. You're out. Your trade's done. You don't have any recourse. You can't say, I wasn't willing to sell it at 93. That's the order you put in, a stop with a market order following it when it was triggered. And then a lot of times what will happen, if there wasn't something really important and fundamental going on, other investors will say, that thing's trading 93? That's ridiculous. And they come in and buy it all the way back up to 96 or maybe even 97, right, where your order wouldn't even have been triggered, but it was, and so many other people were in it with you at the same time that you all got flushed down the toilet at exactly the same time. And that happened in currencies last night. And it's just rare and fascinating. And if you go look at some currency charts, it's what's amazing about it, though, is it's not one company. I mean, it's basically the value of a whole country that just got flushed. Like, Australia's a pretty decent-sized economy. I mean, it's not enormous, but it's big enough. And it fell by 4% in 2 minutes? Crazy. All right, I spent longer on that than I intended to. I hope you found it at least slightly interesting. But, man, you just don't see that stuff very often. You will hear me talk some more finance in the Ross report as S&P futures are down this morning, but not down as much as they were a little bit earlier. Let's just talk briefly about what happened yesterday in the meeting between President Trump and congressional leaders. Obviously, this is a lot of the big news over the course of the day yesterday. And the short version is that nobody is moving off of their positions. Nancy Pelosi, who just with tremendous hypocrisy, but again, hypocrisy doesn't hurt Democrats, but with tremendous hypocrisy, it calls a border wall that she voted for repeatedly. She now calls it immoral. And she tells President Trump and tells the world that President Trump won't get $1 for a wall. Everyone knows the game she's playing. Nobody believes that she actually thinks a wall is immoral. Now, look at the other side of the coin. You've got Donald Trump. Wait, let me finish with Pelosi. Remember, a big chunk of her new freshman incoming members of Congress are very far left. Okay, so she's kind of pandering to them in particular. Okay, so then look at Trump. Trump has his own base. Much of Trump's base cares a lot about the wall. But Trump is also adding to the confusion in a way where he oscillates back and forth. Just a couple of days ago, he said, we're never going to give up on a concrete wall. He used the word concrete. Just 2 days before that or so, a few days before that, he said, you know what, it doesn't have to be concrete. Remember, we can do steel slats. He said, remember that? Beautiful steel slats. So Trump isn't helping because he's not focused on exactly what it is he wants. So until the president comes up with clear wording and doesn't have to abandon the word wall, but he has to make it part of something that is broader. He has to start calling it border security on a more consistent basis. Okay, border security with a wall system to include drones and ground penetrating sensors and things like that. Once the president sets the message more clearly than he has so far, it'll be a lot harder for Nancy Pelosi to stick with not a single dollar. In the meantime, and I'm going to follow up on this later, I was trying to decide who wins and who loses out of this shutdown, showdown over the border wall. And it occurs to me, you know, both sides think they're winning a little bit with their base, but I actually think that it's more of lose-lose, and the biggest loser is any incumbent. We'll be back.
This report is sponsored by Rocket Mortgage by Quicken Loans.
Couple of problems starting out the morning drive.